Okay, picture this. You sell a record number of solar panels, your revenue rockets up 70%, and your reward is, well, negative gross margins.
Yeah, because you basically had to put your entire inventory on clearance just to harvest a government tax credit before midnight.
Exactly. It is March 31st, 2026, and welcome to Earnings Unscripted. Today we are looking at T1 Energy and their wild Q4 2025 results. And honestly, it reads less like an earnings report and more like a regulatory panic attack.
It really does. I mean, we talk about the unintended consequences of subsidies all the time, but here you literally have a domestic solar manufacturer deliberately taking a loss on the actual product just to save the tax payout. It is an incredible distortion of, well, basic commerce.
Right. And before we completely tear into the mechanics of that, just a quick reminder that this podcast is strictly our personal opinions, definitely not financial advice. So please do your own homework.
Or just, read the fine print on these tax bills.
Fair. Okay, but let's talk about the stock action first, because the tape on this is fascinating. Throughout the actual quarter, T1 Energy was on an absolute tear, up almost 200%. Investors clearly bought the whole domestic manufacturing hype. But then earnings day hits, and the stock just completely falls off a cliff in the pre-market, like a 21% gap down before the sun even came up.
Right. It did stabilize a bit once regular trading opened. I think it clawed back 1% or 2% intraday. But the initial shock makes total sense when you actually look under the hood. You have Q4 revenue coming in at $358.5 million. That is a massive 70% jump from Q3. Great, right?
Sounds amazing, at least until you hit the very next line.
Exactly. Gross profit completely imploded. They went from making $21.1 million in Q3 to a $16.1 million loss this quarter. Operating loss did narrow slightly to negative $82.6 million, and diluted EPS just sat perfectly flat at a negative 87 cents.
So wait, let me just wrap my head around this. What actually caused that massive margin collapse? I know it ties back to the new OBBBA law, the One Big Beautiful Bill Act, but how did it hit the bottom line so violently?
So the new law basically bans foreign entities of concern from getting those lucrative Section 45X manufacturing credits starting January 1st. T1 had all this inventory sitting around with Chinese cells that was about to essentially turn into pumpkins. So they ran a literal fire sale. They dumped modules at 3 cents a watt below market pricing just to clear the warehouse and secure the credits before the buzzer. It was roughly a $16 million hit directly to margins.
Wow. Jeez. So they took a guaranteed hit on the product pricing just to keep the government cash flowing. It almost feels like they're not selling solar panels anymore. They're selling tax credits.
I mean, they basically are, which is why their balance sheet is actually the one bright spot here. Despite that margin bloodbath, cash and equivalents surged to $270.7 million, up from just $86.7 million last quarter. Now, that was mostly capital raises, not operations, but they did build the cash moat they needed to survive the transition.
Okay, that makes sense. A really chaotic quarter, but I guess a necessary one just to survive the rule change. All right, there is a lot more to unpack here, especially with this weird AI data center pivot they're trying to pull off in Europe. Let's get into the details.
Yeah, we will definitely get to those Nordic data centers, because that is just peak market absurdity right now. But first, look, I think we need to look at what they actually did to the corporate structure just to survive this new law.
Right. The whole Trina Solar divorce, I mean, reading through that, it sounded like a complete scramble.
A total scramble! Under the OBBBA rules, if a foreign entity of concern has too much control, your 45X tax credits just vanish. Poof, gone. So T1 had to essentially tear down their own operational foundation. They prepaid debt early to get Trina off the books. They stripped them of the right to appoint officers, and they rushed out to buy a fresh intellectual property license from a totally different holding company in Singapore.
Evervolt, right. It is kind of incredible when you step back. They restructured their core IP in the matter of weeks, basically engineering the whole corporate identity around securing a single U.S. subsidy?
Exactly. It is a compliance maneuver masquerading as corporate strategy. But Here's where it gets really interesting for the accounting side. As part of this debt repayment, T1 negotiated a $34 million sales commission waiver.
Right, but I was looking for that on the income statement, and I was thinking, wait, where's the $34 million bump? It was not there.
No, it's completely invisible on the P&L. Strict U.S. GAAP rules kicked in. They were not allowed to book the reversal of that past accrual into current income. So the quarter looks like this massive optical miss on the bottom line, but that $34 million is sitting perfectly safe in cash on the balance sheet.
Wow. Okay, so the headline numbers look terrible to a casual observer, but the actual cash reality is much stronger than that negative EPS suggests.
Precisely. And going forward, dumping those legacy service agreements is going to be a huge tailwind. The CFO, Evan Kallio, explicitly noted they are moving away from the Trina agreements, which saves an estimated $30 to $100 million at a 3 to 5 gigawatt run rate. So, yes, the divorce was chaotic up front, but it unlocks massive long-term savings.
It feels like they're clearing the decks, getting the ugly legacy baggage out of the way. Which, speaking of legacy baggage, can we talk about Norway now? Because this is honestly my favorite part of the entire report.
The European pivot. Go ahead. It is ridiculous in the best possible way.
So T1 has these old industrial plots in Scandinavia, leftover real estate from a discontinued European solar venture. You would normally think, okay, that is just dead weight on the books.
Usually, yes. You just wait for the impairment charge.
But no. Suddenly, it is late 2025, and tech giants are absolutely starved for power for AI server farms, and T1 just happens to hold the local grid allowances for these sites.
Yeah, they have 50 megawatts of grid allowance secured right now in Mo i Rana, Norway, and they are pushing applications for up to nearly 400 megawatts.
And Dan Barcelo, the CEO, was completely leaning into this on the call. He literally said there is pricing in the market right now from anywhere from $500,000 to $1 million per megawatt in terms of power.
It is wild. You fail at European solar manufacturing, but because you hold the keys to a regional power substation, you are suddenly an AI infrastructure play.
It is just the ultimate 2025 narrative. They are trying to flip a solar graveyard into a data center gold mine.
Well, attempting to flip, let's be fair. They haven't cashed the check yet. They are actively trying to market or partner on this asset. But, it completely changes the valuation of those discontinued operations. It goes from zero to potentially hundreds of millions in stranded value.
Which brings us back to the reality of next year. Between stripping out the foreign IP, sitting on hidden cash, and hawking Norwegian power grids to AI companies, where does all this financial gymnastics actually leave them heading into next quarter?
Well, it leaves them holding their breath for April. I mean, phase one of that huge Austin gigafactory is moving, but they still explicitly need another $350 million to actually finish it.
Right. And you listen to CEO Dan Barcelo on the call, and he is projecting so much confidence about getting that money. And he is basically using Elon Musk as a shield.
Oh, yeah. The Texas proxy validation.
Exactly. He literally pointed to Musk building that $20 billion terafab right down the road in Austin. And he basically argued that having Tesla and SpaceX run a similar playbook locally suggests, quote, T1 is on the right path.
Which is, quite a leap. Elon is building near us, therefore our balance sheet is fine.
Yeah, it is a little rich, but you get the sentiment. Domestic supply chains are practically a national security pitch right now.
They are, but looking specifically at the next 3 months, investors need to be really careful. Management maintained their full year 2026 target, around 3 to 4 gigawatts, but they explicitly warned the first quarter is going to look bad.
Oh, because the volume shifting, right?
Correct. Evan Kallio, the CFO, said they are deferring some first quarter deliveries directly into Q2 due to customer requests. It's just supply chain hangover. So they're setting up the excuse early.
Sorry, I guess expectation management is a better word for it. But if an analyst isn't paying attention, that Q1 print is going to look like a massive miss on the surface.
Absolutely. And you stack that on top of the pending Section 232 trade case. If the government rules the wrong way on foreign polysilicon, merchant cell pricing could go completely haywire mid-year.
Wow. Okay, so basically they survived a massive regulatory fire drill. They are riding Elon's political coattails, and they are begging the market to just close its eyes during Q1.
That is a pretty accurate summary. It's high stakes, heavy subsidies, and just a lot of political gravity holding it together.
Let's just hope that gravity holds until they find their $300 million in April. All right, that wraps up our look at T1 Energy. Thanks for hanging out with us, everyone. We will catch you on the next one.
Goodbye.
So if you want these earnings breakdowns to just automatically show up in your feed, you might want to follow the podcast. We actually use AI to help pull the data and shape this dialogue, which is how we can process hundreds of pages of filings overnight and still sound somewhat awake. We'd love to know what tickers you want us to unpack next, so just drop us an email at earningsunscripted@datamadness.ca or grab the X link down in the show notes.
Catch you next time.